Can you please state your name for the record?
My name is Mark Ellis.
Do you recognize Exhibits AG1 and AG2 as your direct and surrebuttal testimony filing in this proceeding?
Yes.
And if I asked you the same questions in those filings today, would your answers be the same?
Yes.
Your Honor, I'd move to admit AG1 and AG2.
Any objections? Hearing none, AG1 and AG2 are admitted.
Thank you, Your Honor. Mr. Ellis, you used to work for Sempra. What is Sempra? How long did you work there, and what was your role there?
Sure. Sempra is one of the largest U.S. utility holding companies. I believe it's in the top 10, a member of the S&P Utilities Index. It's the parent company the history was the parent company of Southern California Gas and San Diego Gas and Electric, and subsequent to the merger of those two companies, they bolted on a number of other businesses in what they called unregulated energy businesses, and they also purchased the Texas utility called Oncor during my tenure there.
And what was your role there when you were at Sempra?
So my role there was chief economist and head of strategy. I was there for 15 years from the beginning of 2004 to March of 2019. And I basically, while I was there, oversaw the corporate strategy and economic analysis functions.
Did that include cost of capital proceedings?
Yes, not cost of capital proceedings per se, but the enterprise-wide cost of capital. So I estimated the cost of capital for all the company's businesses, utilities and non-utilities.
Understood. Thank you. I think it would be helpful to have you explain how your approach differs from other experts in this rate case. So could you sort of briefly summarize what makes your approach different?
Sure. So I think differs in several key ways. One of the most important ones, I think, is the rigorous treatment of credit and the interrelationship between capital structure, ROE, credit metrics, and the utilities credit rating. When I was at Sempra, I worked very, very closely with the Treasurers Group and understood very directly how much credit matters to utilities, and that's why I include it in such a rigorous way in my analysis. I explicitly incorporate credit metrics and credit analysis in my determination of the capital structure and the ROE. So that's one key difference. Another key difference is I adhere very strongly to the principle that really descends from the Federal Power Act and through the Hope decision, that the authorized rate of return should be equal to the market-based cost of capital. And so I start from that premise and work from there. Another key difference is that when I determine the cost of capital, I use the methodologies and methods that I used when I was at Sempra determining the cost of capital for that enterprise, and that methodology upon which the organization made multi-billion-dollar decisions, including the acquisition of Oncor and other businesses. And then finally, I benchmark my results to third-party independent estimates of the cost of capital, like I call them CMAs, the capital markets assumptions, or the forecasts from independent investment advisors and investment managers of the market-based cost of equity for the market as a whole, which provides a very valid and independent benchmark for the cost of capital in the market.
And to your mind, what is the difference between an authorized ROE and the market cost of capital for a utility like TEP?
Yeah. So the authorized ROE is a regulatory construct. It's basically the profit that utilities are allowed to recover in their rates, and it's just a multiplier on the book equity that the utility has invested in the rate base of the utility, which can be completely different. It's just a regulatory determination. It could be much higher, could be conceivably lower than the market-based cost of capital. The market-based cost of equity is the return that investors require on an investment in order to motivate them to provide capital to an enterprise. It could be a utility or any other type of company.
And is the point of this proceeding is to determine what the market cost of capital is for TEP, right?
Yes.
Okay. One of the areas that you focus on in your direct testimony is market-to-book ratios and that relationship with authorized ROEs. Can you explain briefly the connection between those two?
Yeah, so the market-to-book ratio really just descends from one of the most fundamental principles in all of finance, which is called present value. And it's basically if you make an investment of $100 that just earns its cost of capital, right, in the future, in other words, the expected return is just equal to the cost of capital, then the present value is the discounted value of those future cash flows, will just be equal to the initial investment. So if I buy a government bond, when I buy a government bond, for example, and it's, has a yield of 5%, and I buy a $100 savings bond, it will, the value is equal to, on the day I buy it, is equal to $100. If the interest rate changes, if it drops the next day to 4.5%, then the present value will go up because now it's being, that 5% stream of cash flows is now being discounted at 4.5%. That's the new market interest rate. So the market to book ratio just tells you the present value in the market relative to the initial investment. And the flip side of that is it's a barometer of whether the authorized rate of return is actually equal to the market-based cost of equity, because if they're equal, then the market and the book value will be the same. If the market is higher than the book value, that means the return on the initial investment is much higher than the market-based cost of equity.
Do you have an exhibit marked S7 in front of you?
Yes.
Okay. Could you please go to page 42 of that exhibit? And this is, I believe, Mr. Parcells' direct testimony, marked S7.
Yes. Yes. Yeah. Page 42 of Mr. Parcells' testimony. Mm-hmm. Mm-hmm.
Do you have what you need, Your Honor? Can you read lines 11 through 19 to yourself and tell me what Mr. Parcell is explaining here about the market-to-book ratio?
He's basically stating essentially what I just said. In other words, he's saying, hey, the utilities trade at a market-to-book ratio greater than 1, and which is an indication that the ROEs are greater than the cost of equity.
Thank you. Let's talk a little bit about some of these third-party benchmarks that you referenced. These are called capital market assumption reports, is that right? Mm-hmm. Also known as CMAs. Mm-hmm. And you use those reports to sort of benchmark your utility ROE determinations, is that right? Mm-hmm. What is a CMA? CMAs are reports that are produced by many of the largest well-known investment management firms. So it could be BlackRock or JP Morgan, Goldman Sachs, Vanguard, State Street, names that we're all familiar with if for our retirement accounts or we just hear about them in the news. And collectively, these organizations are responsible for literally managing trillions of dollars of other people's money. And these CMA reports are forecasts that they use to determine their allocation of customer money into various portfolios. So the CMAs cover not just the U.S. market, but often international markets, bond markets, currencies. But the idea is it is their best estimate of the expected return for on these different asset classes. And one asset class that they all estimate is the U.S. market as a whole. Just for the benefit of the record, what is an AAU? Maybe I misheard you, but did you have an acronym called an AAU?
Assets under management?
Perhaps so.
AUM, assets under management.
Sure. So as part of your direct testimony, you surveyed 46 of these CMAs. What did that survey reveal to you?
So the survey revealed that across the board, their estimates, they vary, right? These are independent organizations, but across the board, they average about a little bit over 6. I think it was 6.06%. And I think the highest was a little bit over, maybe 8.5, 8.9, but none of them were anywhere close to the greater than 10 estimate that TEP is requesting here. And I think importantly, I think everybody agrees that utilities are lower risk than the market as a whole. So we should expect the authorized ROE and the cost of equity for the utility to be lower than the market as a whole. So somewhere in the 5s or 6s is using this benchmark. Again, these are the most well-respected, best resourced investors in the world who are coming with these numbers, and they're not involved in utility rate cases, so they don't have any, reason to skew their numbers in any particular direction.
And so your conclusions about the market-to-book ratio and your survey of CMAs, that's also consistent with academic research that you've found that shows authorized utility ROEs often exceed the market-based cost of equity for those utilities. Is that right?
Yes. Yeah.
Okay. And so is it fair to say that all three of these types of evidence tell us that cost of capital models that are designed to replicate authorized ROEs or are benchmarked against authorized ROEs simply carry forward those errors?
Yes. Yeah.
I want to talk a little bit about modeling assumptions. I think one of the key areas of disagreement between you and Ms. Bulkley is your long-term growth rate assumptions for your cost of capital models. Could you please briefly explain how you selected your long-term growth rates and how those selections impact your estimate for the cost of capital?
Sure. So I think maybe start with what is a DCF model actually modeling.
And a DCF is what?
Discounted cash flow model. So that's one of the key models that virtually all cost of capital consultants or experts use in utility regulatory proceedings. So basically it's the discounted present value of a stream of cash flows into perpetuity, infinite, forever. And that's a key assumption of the model, is that a DCF model is modeling cash flows into perpetuity. So that puts a constraint on, just an economic and logical constraint on what the long-term growth rate could be in these DCF models. So it has to be tied to something that reflects economic reality. So for example, no individual company or sector within the economy can grow faster than the aggregate GDP into perpetuity, because just mathematically, eventually it would exceed the entire economy if it grew faster than the economy. And you can come up with any illustrative model or numerical example of this, and eventually it overcomes the entire economy. So that puts a constraint on the growth rate in the DCF model, the perpetuity growth rate. And again, every single DCF model incorporates in it a perpetuity growth rate. That's intrinsic to the model. So that creates a cap. So that's sort of a mathematical cap. And then there's the empirical evidence of how have the utilities and the market as a whole, because these models are used in two different places, typically in the cost of capital analysis, in the DCF model, and then later in the CAPM model. Empirically, how have dividends grown historically? And we have, there's a publicly available data set that I like to use from a very well-known finance professor at Dartmouth. And he has nearly 100 years of data, and what the data show is that for utilities, dividend per share has basically just kept pace with inflation for the last 100 years. And in my testimony, I explained sort of what's going on economically, why their dividends grow so slowly relative to the market as a whole. It has to do with their dividend policy. They actually distribute most of their earnings. And then the other finding from that nearly 100 years of data is that for the market as a whole, dividends grow, they track GDP per capita. And in my testimony, I explained sort of what's going on from an economic perspective that caps the long-term growth of dividend per share from the market at GDP per capita, not GDP, but actually GDP per capita. And there's some academic research that explores this issue as well, linking stock market returns and growth to the greater economy. That's an active area of academic research. It has been for decades.
So your growth rates that go into the DCF models, they are consistent with the principle you outlined that no company can outgrow the the entire economy that surrounds it indefinitely.
Yes.
Okay. What if a model assumes that? What does it say about a model that assumes that a company could actually outgrow the U.S. economy?
It would overstate the cost of equity, whatever resulting cost of equity estimate was derived from a model that assumed that it could grow faster than the U.S. economy. And
how, in terms of weighting, can you give me a rough sense of how important that long-term growth rate is to the actual output from those models?
Yeah. So it depends on the version of the DCF model. So TEP uses what's called a constant growth DCF, which is basically, I mean, to the first order of estimation, there's a slight adjustment to this, but it's basically the starting dividend yield plus this long-term growth estimate. So it's all, for their model, it's 1-for-1, the long-term growth estimate, and so if the long-term growth estimate is overstated by 2 percentage points, that yields, or 3 percentage points, that yields a cost of equity estimate that's overstated by 3 percentage points.
So a 1% overstatement does translate fairly directly to a 1% increase in the required ROE.
It's actually a slight, there's an adjustment to the dividend rate based on that growth rate. So it's actually a little bit more than, but it is 1-for-1 plus.
Approximately.
Yeah.
One of the main critiques that TEP has lodged about your recommended ROE and capital structure is that it is substantially below authorized ROEs in the last 40 years. How do you respond to that concern?
Well, according to Hope, the authorized ROE is not the regulatory standard. And in fact, this has been repeatedly endorsed in Supreme Court cases, Circuit Court cases. It's been endorsed by academics. It's been endorsed by FERC, that the authorized ROE is not an appropriate benchmark for determining the cost of equity. In fact, in a series of proceedings that are still ongoing, FERC has said to base ROEs on other authorized ROEs or models that use authorized ROEs defies general financial logic. So they've come down pretty strongly, like this is not an appropriate way to determine the cost of equity, is to look benchmark against other authorized ROEs.
And one of those models that FERC is concerned about is the risk premium model that Ms. Bulkley uses, correct?
Yes.
Thank you. Another critique is that your cost of capital estimates produces only a small difference between the yield on TEP's most recently issued long-term debt and your price for equity. This was the crux of the 2 North Carolina decisions that Ms. Bulkley testimony cited, correct? Can you walk us through a little bit? First of all, is that a valid comparison between a bond yield and a price for equity?
No, it's not. On its face, it sounds like it would be an appropriate comparison, but it's not, because the yield to maturity on a bond or any type of debt is a very different construct. It's measuring a different stream of cash flows and a different risk profile than the expected return on equity. And I can walk through some of the key differences about why it's not appropriate to compare, for example, TEP's most recent bond yield, the yield on its most recent bond issuance to cost of equity estimate.
Rather than do all of that, can you give me an example of something that's compensated in equity that's not compensated in a bond yield?
It would be the reverse, something that's compensated in a bond yield that is not compensated in equity. So the one that's very well known is what's called a liquidity premium, or illiquidity premium. So when you buy a stock, it's very easy to buy. You can go on E-Trade or Robinhood, and it's a very liquid market. Bonds are much harder to sell, and it could be, and when bonds are in distress, it can be very hard to sell them. So as a result, investors expect a higher return on the interest rate that they charge somebody to lend to them than they would for an equity. So that's illiquidity premium is one. Another key difference is that a bond yield is actually just a promise. It's the yield to maturity. And we all know that even very, very high-grade bonds have some risk of default. So you have to adjust to reflect the expected return difference between the expected return on a stock and the expected return on a bond. So those two, just in and of themselves, would make the yield to maturity, to make them comparable to the expected return on equity, you have to deduct both the illiquidity premium and default risk. There are other issues as well about why they're not directly comparable, but those are two of the big ones.
Do you know of any investors that determine a required equity yield by comparing them to a single bond issuance?
No. The only thing that's comparable is when you use the risk-free rate and the CAPM. But setting the expected return on equity based on a single bond issuance, that's not a commonly used model. In fact, if it were, we would see it in these cost of capital proceedings, but that just isn't done.
And are you aware of any financial principle or legal requirement that a premium of equity to debt be a certain size?
No.
Okay. No. So even if the comparison might seem intuitive in a sense, all it really tells us is that there are two numbers that are similar for a particular company.
Yes.
Your testimony focuses on the quantitative factors that credit rating agencies use to assess utility creditworthiness. Your recommendations produce credit metric outcomes that would maintain TEP's credit rating according to those published quantitative standards, correct?
Yes.
Your Honor, I'm just going to ask a question. I thought we were going to have summaries at the start of testimony, not repeat pre-filed testimony. I did take liberty to walk through a couple of exhibits to clarify them, but we're basically obviating the need for pre-filed testimony at this point. And if I misunderstood Your Honor's direction to us, then please let me know.
That was the general idea, to try to save as much time as possible for cross and to focus our efforts in that regard and to not spend a lot of time summarizing pre-filed testimony, except as to sort of highlight areas of disagreement or where there may be confusion. So I'm going to allow you to continue, Mr. McCoy, but we just don't need to spend a lot of time doing that because the parties and myself have all thoroughly reviewed the pre-filed testimony in this case. You can assume that I have the foundation for Mr. Ellis's testimony.
Wonderful. I'll keep that in mind, Your Honor. I apologize. Well, let's skip ahead to the punchline then. As far as you know, there's no evidence in the record that contradicts your quantitative findings that TEP's credit rating would be maintained.
No.
Okay. I think one of the areas that, an additional area of criticism that your recommendation faces is issues with qualitative credit metrics. Can you describe briefly your understanding of what those qualitative metrics are and how they operate?
So some of the qualitative metrics that the rating agencies look at are just the general regulatory environment, the ability to recover costs, the approval of expected costs and so forth. In my quantitative analysis, I assume all of those are unchanged.
To your knowledge, do ratings agencies look at something like the authorized ROE in the abstract, or do they look at the overall regulatory framework?
They actually don't look at ROE. They look at the ROE's impact on cash flow, which is why I optimize around the cash flow metric in my analysis. There is no, when you look at the methodologies of Moody's, for example, there is no mention. They mention ROE, but it's not one of the quantitative metrics that they use in determining their ratings.
Does your recommendation impair or otherwise impede TEP's ability to timely recover its costs?
No.
It simply changes how much costs they recover.
They still recover all their costs. It just determines how much profit they recover.
I want to focus now on some concerns that Mr. Callahan and Ms. Bulkley have raised about the potential for a downgrade. And I know your testimony is that that won't occur, but I want, for this series of questions, I want you to assume that it is. Are you aware of any utilities that have had their credit ratings downgraded and then they were subsequently able to raise sufficient capital to fund their operations?
Subsequently not able to or able to?
Unable.
Unable. Not that I'm aware of. Even PG&E, which actually went bankrupt, was still able to raise capital to fund its operations. But two utilities that have had recent downgrades are APS and I forget which one. There was a utility in Connecticut had a downgrade, but they were able to access the capital, continue accessing the capital markets.
So in your mind, would that satisfy the standard set out in Hope and Bluefield for reasonable accessing capital on reasonable terms?
Yes.
Generally speaking, how do savings to ratepayers from a lower authorized return compare to higher incremental borrowing costs from a downgrade?
Yeah, I do this calculation. I've done this calculation many times, and in general, the savings from a lower ROE that might trigger a downgrade, and then there's an incremental increase in the cost of debt, right, that could be traded off. That is not my assumption in this proceeding, but I have calculated that hypothetical. It's typically 20 to 1. In other words, customers save 20 times more on ROE when you include the gross up for taxes than the incremental cost of debt that they might incur from a downgrade. Sometimes it's higher than 21, but it's all 20 to 1, but it's almost always 20 to 1 or more.
So, and are you aware of any rate-making principle that requires that the commission, a regulatory commission, set authorized ROE to maintain a particular stock price for a utility?
No, that was addressed in HOPE, and they said it's explicitly not the regulator's concern to maintain a particular stock price.
So, stepping back here, if the commission reviews all the evidence and they determine that your recommended ROE and capital structure reflect the returns required by investors to maintain TP's financial integrity, would that satisfy the Hope and Bluefield standards as you understand them?
Yes.
Thank you. The witness is available for cross-examination.
All right. Thank you, Mr. McCoy. All right. We'll start with you, Mr. Smith.
No questions for this witness. Thank you.
Mr. Borman?
I have no questions for Mr. Ellis.
Mr. Borman does not have any questions. Ms. Cavalier?
No questions, thank you, Your Honor.
Questions from APS?
No questions, thank you, Your Honor.
Mr. Adams? We have Mr. Adams. Ms. Johnson?
Thank you, Your Honor. I just have a couple of questions. Good afternoon, Mr. Ellis. Can you hear me okay?
Yes. Yeah.
Okay. PG&E has come up a couple of times today. Was PG&E's most recent bankruptcy the result of an ROE lower than requested, or was it the result of multiple wildfires that resulted in significant damage and loss of life?
It was a result of the wildfires.
Okay. And when you were just talking with Mr. McCoy, you mentioned the Hope case. It seems to me that the utilities rely on the Hope case to justify their high ROE requests. Did you hear my questioning this morning of Ms. Bulkley?
I did not.
Okay. I referenced the Hope case and I asked whether or not under Hope, a standard of return above the cost of capital is just and reasonable. Do you have any opinion as to that?
It is not considered just and reasonable to authorize a rate of return above the cost of capital. Regulators have some discretion to do that, but typically it's under the expectation that there's a compelling reason to authorize a rate of return above the cost of capital.
Okay. And I also asked if it's appropriate for the utilities to point to other utilities' high ROEs as a reason to justify their own higher ROEs. What is your opinion as to that?
I believe that's inappropriate. I believe that was the utility sector as a whole, people involved in it and FERC, as I said, knows that that's not an appropriate comparison.
Okay, and then my last question is just about what the impact of ROE is on customer bills. Do you believe that higher ROEs negatively impact customers, specifically their bills?
It raises raises rates and customer bills. So if higher bills that are sort of excess profits that aren't tied to the actual cost of capital harms customers, then yes, it harms customers.
Okay, that's all my questions. Thank you.
Ms. Reyes?
No questions for this witness, thank you.
All right, Ms. Bustamante?
No questions, Your Honor, thank you.
Mr. Corbin? Mr. Nelson? Ms. Smith?
No questions, Your Honor.
Mr. Dempsey? Mr. Dempsey does not have questions. All right, Ms. Barrios-Cool?
Hello, Mr. Ellis. I'm going to try and keep this brief. I heard you just say when discussing with Mr. McCoy that you understand Hope as not requiring or not stating that authorized ROEs are the appropriate way to develop new ROEs. Did I understand that?
Yes.
Okay. Can you tell me how from a cost of capital perspective and not as a legal opinion, you square that with your understanding of Bluefield?
So which aspect of Bluefield are you referring to?
The comparison that's required there.
Yeah, so it's commensurate returns to investors in the market.
Okay.
Investors can't invest directly in TEP. They buy the stock, the traded stock.
Right. You recommend a 6.0% ROE, a 56.8% equity ratio, and a 0.0% return on the fair value increment, correct?
Yes.
Did the CMAs that you referenced when discussing with Mr. McCoy indicate, from your perspective, a need to supply investors a return on the fair value increment higher than 0.0%?
No, the CMAs wouldn't justify anything other than 0%.
I understood you to tell Ms. Johnson that you did not hear Mr. Rodemaker's testimony yesterday. Is that true?
Yes.
Okay. I want you to consider a hypothetical scenario. I want you to consider an adjuster mechanism that adjusts the entire revenue requirement. And as it does that from year to year, the capital structure may be updated from year to year. The cost of debt may be updated from year to year, but the ROE stays fixed. Would such a mechanism concern you?
I don't have enough information to have an opinion. I've never heard of such a proposal. But I was asked, how does my testimony differ, right? And I said it looks at the ROE, the capital structure, and the cost of debt, credit metrics, all as a one integrated system and optimizes across them. So if you held ROE fixed, but varied the capital structure over time, it's unlikely that you would be able to maintain the target credit rating over time if you did that. So I would have, just from a mathematical perspective, I would have some concern with that, but I have to see the actual proposal and so forth to have does that make sense from a regulatory perspective, how far out of alignment you would get if you did something like that. Okay. But in general, the ROE or the cost of equity and the capital structure, they're linked. And so if you vary one, then the other one may have to be varied as well.
Okay. And just for the clarity of the record, is it fair to say you didn't analyze the TEP's proposed ARAM in this case?
No.
Okay. Notwithstanding the differences between your recommendations for cost of capitals and others, is it fair to say that your recommendations still contemplate a customer rate increase?
I didn't calculate in my testimony. I calculate the difference between the rate under TEP's proposal and my proposal, but I did not benchmark it against current rates. I believe there may be some public documents that explain what that number would look like, but I did not do that calculation myself.
Okay. But fair to say that you agree your testimony offers the Corporation Commission one choice among alternative views as to the cost of capital?
Yes.
Okay. No further questions.
Ms. Humphrey?
No questions, Your Honor.
Okay. Mr. Patton?
We don't have any questions, Your Honor.
I do have a few. And Mr. Ellis, I don't know if you are familiar with these proceedings or if you've testified before the commission before, but I just want to let you know that my questions are sort of from a standpoint that's a little bit different than the parties. My task in this case is to issue a recommended opinion in order for the commission's consideration. So I ask questions to better understand your position and how I may reconcile your position with those of some of the other parties in what I ultimately end up drafting in this case. Is there any part of your ROE analysis that you would consider to be controversial or not widely accepted by other professionals in your field?
That's a good question. when I have had conversations with other cost of capital experts who work on the consumer advocacy side, virtually every single one says your methodology is the correct one, but they don't feel it's politically acceptable, or their client won't allow them to do analysis that's comparable, to produce a number and therefore do analysis comparable to mine.
Okay. Right. So your proposed ROE is significantly lower than what's been adopted previously for TEP and for other Class A utilities in Arizona. It's also significantly lower than what the other parties in this case are proposing. So I guess I wonder that if the commission were to adopt your proposal, what impact do you think that would have on investors when they're looking at sort of the relative difference between TEP with its new authorized ROE and what else has sort of generally been out there?
So we can think of investors in two groups, debt investors and equity investors. And I'm very explicit, hey, debt investors are going to have as an attractive opportunity to invest in TEP as they currently do. It could potentially be even better. Some of the other, I focus on the cash flow to debt metric, but there's other quantitative metrics that actually improve. So you could see them being more interested in providing debt to TEP under my proposal. In terms of other investors, there's oftentimes this canard, if you reduce the ROE, investors will flee. But that sort of betrays a misunderstanding of how capital markets work, right? Because for every seller, some investors will be upset and they will decide to sell. Well, in this case, it's not even TEP, it's Fortis, decide to sell Fortis. But every person who sells, there's another buyer who says at that lower price, I think it's a good deal. So the idea is there will likely be some adjustment in the stock price. But as I referred to earlier, Hope kind of put that to the side, that there was a recognition very early on that the stock price is a reflection of the ROE that we determine. And the ROEs, as I try to communicate in my testimony, are completely out of line with the legal and regulatory standard. And so we have to start correcting that. So there will be a short-term impact on Fortis's stock. Keep in mind, Fortis is a big holding company, and TEP is only one small part of it. It would be very different for a utility like PG&E or Edison, where the utility is the entire company. So in terms of the impact on investors in Fortis stock, pretty negligible. And then once the ROEs are reset, the stock price drops a little bit. There's a revaluation of the entire company, and investors may see it as more attractive going forward because they will know that the commission is making a decision based on like real solid analysis, and that if ROEs if the cost of equity does go up in the future, that the commission will track it because they are basically adhering to that standard. And I'll give you an historical example. In my testimony, I have a chart of the market to book ratios, and if you recall, there's a period in there in the 70s and 80s where the market to book was too low, and many cost of capital experts, including some of Witness Bulkley's colleagues at the Brattle Group, wrote a book saying, hey, the market to book is a guide to regulators. It's too low, which tells us that the ROEs are too low. So there was a period when interest rates went up, cost of equity went up, and regulators lagged. And that hurt these utilities stockholders. They continued to invest and raise capital, but it did hurt the stockholders of those utilities because the regulators didn't keep up. So an argument could be made that if a regulator decides, like, no, I'm going to take this cost of equity seriously and actually track it and set it, that it reduces investor perceptions of risk. Again, it's a different valuation. The valuation will be closer to the book value, which is the intended standard. But investors, after that initial drop, may like the stock better.
Okay. But you do acknowledge that there may be some sort of correction period.
In Fortis's stock, yes.
Okay. Do you see any potential harm to TEP from that?
No, because Fortis, remember, TEP's capital comes primarily from reinvested earnings and then a little bit from Fortis. And Fortis, would continue to make a decent return on their equity in TEP.
All right. And your direct testimony also says that reducing the ROE as you've proposed would maintain TEP's credit rating.
Mm-hmm.
Are credit rating agencies concerned with regulatory stability? And if so, would sort of a dramatic change in the regulatory environment from adopting your proposal potentially have a negative impact from the perspective of the credit rating agencies?
So the rating agencies are not concerned with stability per se, but the projected stability. So a one-off, hey, the credit rating is maintained, but reducing the ROE, as long as the commission is communicating, like we intend to maintain TEP's credit rating in the future by adjusting the equity ratio and the ROE together to maintain the credit rating, that would be seen as a positive. Right now, they don't have that confidence, right? Because the ROE and the credit and the equity ratio are kind of determined independently, and so if there's a commitment like, hey, we all agree, TEP and other utilities should have strong credit, but it doesn't mean strong credit should come at the expense of customers per se. And if the regulator makes that type of commitment, that would be seen as I don't work for a credit rating agency, but my understanding of how they make decisions is they're always looking forward, and they're looking for stability and clarity about how the regulator is going to be making decisions going forward.
Question asked different ways. Okay, you made a comment in your direct testimony about excessive ROEs potentially incentivizing utilities to unnecessarily expand their rate base.
Yes.
Is there anything specific to TEP that you've looked at or that you can point to where you think it has unnecessarily expanded its rate base due to an excessive ROE?
No, this is just a general phenomenon. I can't say from my experience at Sempra. I lived and breathed that for 15 years.
And Ms. Barrios-Cole asked you a little, just briefly about the ARAM, and it doesn't sound like you looked at that in this case.
Yeah. Okay. Can I add one thing about your earlier questions about the credit and so forth? One thing I want to make clear is just how much a credit downgrade would increase the cost of debt for TEP. So it varies, of course, over time, but typically a one-notch downgrade for a utility increases their incremental cost of debt. In other words, the historic cost of debt doesn't change; it's already contractually set, but the incremental by 5 to 10 basis points. So when you have a one-notch downgrade, it's not like, oh, the cost of debt goes from 5 to 7. It goes from 5 to 5.05 to 5.1. So it's a pretty small increment because utilities in general are starting from a very, very strong credit position. To go from an A3 to a BA1 is, it's still very, very strong credit.
And does that increment vary as a downgrade may progress?
Yeah, if you go down, start to get into junk territory, then the increment gets bigger.
Okay.
But if you're triple B and above or BA2 and above, it's about 5 to 10 basis points in that range.
All right. So in these cases, as I'm sure you're familiar with now, we have lots of rounds of testimony and parties update their positions to sometimes align with others or comment on other testimony. So rebuttal testimony, I didn't see any other party's cost of capital witness sort of revise their testimony to align more with your position. Is there anything that we should take away from that?
Well, you asked before about, do other cost of capital experts agree with me? I can't speak to what's motivating them. I did not deliberately address the flaws, what I perceive as the flaws in their testimony. But for example, some of them use this constant growth, DCF, right, with unrealistic long-term growth rates. Some of them are still using models that are benchmarked to other authorized ROEs, either directly or indirectly, which, again, that's just on its face seems very, on its face, anybody who understands the cost of equity knows that that's not a cost of equity model. I can't speak to why they don't use more. The methods I use are all very standard in the world of corporate finance, which is why these CMAs from these investment firms, their numbers are very similar to mine. That's the norm. I can't speak to why other costs, even on the non-utility side, why they're not doing sort of textbook finance. I don't know why.
Okay. All right. You suggested in your testimony that we should adopt a market-based approach to utility equity financing.
Mm-hmm. You're referring to the last section?
Yes.
Yeah.
So can you just explain that to me a little bit more, what that would look like, what that might mean for a process in terms of our cases?
Yeah. So essentially, you're just cutting and pasting how they issue debt. So just at a high level, utility comes in and says, hey, in this rate case, I'm going to I need to invest $2 billion of incremental CapEx into my system to keep it running. And the commissioner's like, oh, we agree, that's reasonable. So they have to go and issue some additional $1 billion of debt. Just assume for talking purposes, it's 50-50 debt and equity, just to keep it simple. They issue 50% of debt or $1 billion of debt, and 50% of it is equity, $1 billion of equity. For the debt, it's just a given. Hey, you go to market, right? You issue bonds and the market is determining, right? It's a competitive process. The bond market isn't quite transparent, but it's basically bidders are saying, I need, in order to give you TEP, in order to give you $1 billion of debt, I need whatever, 5.9, and somebody say, I'll do it for 5.85, and sort of the market clears at 5.85. We're basically just copying that same principle, but in contrast for the equity, so TEP says, I'm going to go to Fortis, and Fortis wants 10% or 10.07% or whatever the number is. And then there's a negotiation with the regulator, and that's how it's determined. It's just a regulatory discussion. There's an age-old principle, regulation from the days of Edison and Samuel Insull and so forth. Regulation is a surrogate for competition. In other words, where you can have competition, it's always preferred. Back in the day when the current regulatory model was set up, even the U.S. government couldn't go to the market, for example, to finance the Panama Canal. They went to J.P. Morgan. But now capital markets are much more fluid and liquid and sophisticated, and there's no reason why you couldn't run an auction process where, hey, I want to invest in I want to raise $1 billion of equity for TEP, and people can bid based on the ROE that they're willing to accept. And I've been working on this idea for a while. Have some model legislation. We're working with a couple of states to introduce legislation on this idea. I have co-authored a paper with a couple of Yale Law School professors that we're in the process of getting published. So we've done a lot of homework on this, and it's not the idea of running a financial auction from a financial markets perspective is pretty straightforward. From a regulatory perspective, it's something new. But regulation has a history of introducing new ideas, competitive wholesale markets, retail competition, net energy metering, all kinds of innovations. And this is just following in that path. So it's in terms of setting up the process, it's from a software platform perspective, pretty straightforward. It's more the regulatory impetus, like, hey, let's do this. Utilities, you have to do something like this. Hope that answers your question.
And have any other states adopted this approach yet?
No, but several are considering it. Okay. Yeah.
I don't have anything further.
I have a few questions spurred by your questions.
Okay, can we take redirect first before we do recross?
Of course. I'm sorry. I should have had more.
No to redirect from us, Your Honor.
Okay, and then Ms. Barrios, cool. Let me just stick with the original order, or else I'll get lost. Ms. Johnson, any recross?
No, thank you, Your Honor.
Okay. Let me go through the order that we did original cross, and then I'll go to any extras. So, Ms. Barrios, cool.
Mr. Ellis, you used the words regulation as a surrogate. And I want to ask you, are public utility commissions meant to impose regulation to do for monopolies what markets would do if the company was not a monopoly?
Yeah, I mean, I don't think that's formally law, but that's basically regular bond right standards and so forth. Like that's accepted practice. The regulation should mimic markets.
Fair to say it's sort of a bedrock understanding of utility regulation?
Yeah.
Okay. And are stock price corrections a natural part of the market?
Yes.
Okay. You were talking about the number of basis points that are impacted with respect to the cost of debt. Do you remember that?
Mm-hmm.
And I wanted to see if the converse is also true. So, for instance, if there were savings with respect to the cost of debt because of a improvement in credit rating, would you assess that to also be somewhat small, such as 5 to 10 basis points?
Yeah. Yeah.
Thank you.
Oh, okay. Thank you. Mr. Patton.
Nothing further, Your Honor. Thank you.
Okay, Mr. Dempsey, you have something?
Hi. Yes, just a quick one, and you kind of hit on this, so I just wanted to clarify it. So, in your experience in understanding capital markets, do new investors like paying the lowest price or the highest price?
When buying a stock?
Buying an equity.
You know, buy low, sell high. They prefer to buy low.
Right. Yeah. Thank you.
Okay, last opportunity for Ross.